Friends, today we will use a series of very wonderful and classic examples to talk about this capital around the futures infighting, a so normal financial derivatives. Why can pull burst bond market, pull burst stock market, pull burst oil prices? What is the logic behind this? China's financial markets have a very famous 327 incident. An ordinary treasury bond futures, only 8 minutes of the capital battle, 8 minutes caused the entire market earthquake, causing the mainland to suspend trading in treasury bond futures for 18 years. In other words, it indirectly reshaped the continent's financial regulatory system. The 327 incident took place in January 1995, and there was a treasury bond futures contract codenamed 327. The futures themselves are actually nothing special. But at that time, the Ministry of Finance had a certain policy of subsidizing the preservation of the value of treasury bonds. Actually, we have no idea exactly what the discount rate is. The Ministry of Finance made the decision. So there was a big difference in the market about this speculation, and there was a big uncertainty. So there were two forces betting against each other. The long side was mainly the China Economic Development Trust and Investment Corporation, or CICC for short. And the key point was that the short side was mainly Wanguo Securities. So CICC opened the multi-investment, airdrop is the world and Li Alpha. We are actually betting that the next subsidy will be higher or lower. The analysis on the side of the world is more convinced that this hedging subsidy has peaked, and the price of treasury bond futures will definitely fall. In total, he has probably shorted 400,000 short orders. The price of 327 T-bond futures fluctuated between 147 and 148 at that time, but it didn't take long, on February 10, for the world to get a kick out of it. In March, the Ministry of Finance announced a record rate of subsidies to hedge the value of assets. Futures prices rose to more than $148. That's going to be rough on the world. The situation doesn't seem promising for them. Is this the time to cut and run, or to carry and see? And that the subsidy would come down, and the price would definitely come down, he decided to double his bet from 400,000 to 800,000. You see, from this point on, he will fall into this death spiral. In the next few days, the futures price will start to rise from 148. And the world is really very confident that this short position will continue to rise, up to 1.4 million. So at this point, he's kind of putting himself on the spot. Actually, originally 400,000 mouth position, although also many, but for the volume of the world is also normal. But now it's more than tripled, so it's a bit of a play on the fate of the whole company. He can only hope that in the end the Treasury will actually bring the subsidy down. Do you think that's possible? It's not that the Treasury can't step down. But if it does, what are we talking about? On the night of February 22 end, the world suffered another blow. The Ministry of Finance issued proclamations Nos. 1 and 2 of 1995. Announcing that the 3-year bond interest rate was 14% and that the subsidy would remain in place. All in all, a big boost to Treasury debt. The futures jumped to 149.50, up $1.3 from the previous day's close. A $3.0 doesn't sound like a lot, and while it won't be as volatile as Bitcoin, the problem is that at the time, both sides were 40 times leveraged. For Wanguo Securities, for every yuan increase in the futures price, he is not losing less than 1%, he is losing nearly 30%. We airdrop 140 million at that time to calculate. Treasury futures rose $1, corresponding loss is 280 million yuans. Now, you may think that hundreds of millions of dollars is not much for this kind of financial institutions. It is small money. That was a lot of money for a security of this size in 1995. In 1994, its net worth was less than $2 billion. Who could stand to lose $280 million for every dollar that Treasury futures rose on this seemingly mundane trade? We just said that a lot of, in fact, is all background. At present, the situation is actually quite clear, saying that the price of government bonds may continue to rise. Under such circumstances, both the long and short sides have reached the final day of battle. On February 231995, didn't the futures open at 149.5? The high-altitude battle between the two sides is still fierce, with their own advantages in the capital. Once the price down to less than 1 for 9, short once dominated. But at this time you have to think clearly. For the nations and Liao dynasty, what is their goal? Thereby allowing their short positions to be closed. How the price comes down? We need to put the price down first. Put the price down, you have to short more futures, you have to increase their short positions. So the ideal situation, I spend 10,000 to put the price down. By 2000, then 10,000 to put down, then by 2000, this is ideal. The problem is that the fundamentals aren't there. So there aren't that many people willing to go short. So a big wave of bulls rushed in and bought 327 Treasury futures. By midday, the price was over 150. Guan Jinsheng, chief executive of China Securities, even went to the exchange to ask if it could suspend trading or cancel some previous transactions, but was turned down. At this time the market has become the power of the long overwhelming, and at this moment, the world again ushered in his former ally Liu Guofa. A look at the situation is not good, decided to close his hand, airdrop 500,000 mouth. In fact, the light position may be okay, but he jumped the gun, and in turn did more than 500,000 mouth. Completely stood on the opposite side of the world, so that the futures price suddenly jumped $2. 151.98. This time not long from the B market, the world has no way out. If he chose to surrender at this time to liquidate, it means a lot of buying. Then you are close to the B market, you want to buy so much, but not necessarily so many people to sell, which means the price may have to be raised a few dollars. This is no different from declaring yourself bankrupt. You see, a seemingly unremarkable deal has now put the giant international securities to the wall. But it wasn't over yet. Before the 8 minutes had passed, this world with no way out, he came up with a dirty trick. I'll fight you. I'll use the power of my capital, and then I'll use the characteristics of futures margins. I'll concentrate all my strength on fighting the bulls. I'll try my best to short. You see, when the price falls, the long side will ask for the margin. The price must fall enough, the margin cannot be paid. The long side will be crowded out, will be forced to liquidate, forced to sell. Then this time I can take the opportunity to buy this airdrop. Not only can smooth liquidation, or even take the opportunity to make a lot of money. Do you see? This margin system gives airdrops the last chance and multiples purely based on capital strength, and there are no fundamentals here. No prices, no amount, and the goal is to corner the market. The only way to survive is to kill the shorts. Before the sell-off, the market had its legendary 8 minutes of madness. The world focus all capital strength crazy short 37 T-bond futures. First 50000, the price from 151.3 down to 150. And then continue to increase the intensity of the loss hit down. The price broke 150,149,148. The final sale was a staggering 7.3 million lots. It was a staggering 20 million hits in 8 minutes, more than 10 million by some estimates. That's more than 9 times the notional issue of 327 bonds. The world's most powerful short seller has crowded out many longs in the market. In the end, there were no longer longs. At the end of the day, he hit $147.4 from $151.3. He made billions in that 8-minute clip. By the end of the day, the entire 327 Treasury bond futures market had a staggering face value of 850 billion yuans, equivalent to 14% of the country's GDP that year. As I said it, I was kindled. This practice of Wanguo securities is definitely illegal. Seriously exceeding the single volume limit of the exchange, and also failing to pay the initial margin. And most importantly, this is clearly a way to manipulate and distort the market. And they haven't even had a chance to celebrate yet. That evening, the emergency meeting of the Shanghai Stock Exchange announced that all trading in the last 8 minutes was cancelled. And the closing price was adjusted back to 151.3 from 147.4. Wanguo securities went from a profit to a loss of 1.4 billion yuans. It's really hard to stand up after being beaten. Later, in order to avoid a run on Wanguo securities, the Shanghai Stock Exchange and other financial institutions raised 1.5 billion yuans for Wanguo securities to help him turn over the funds. But after the incident, Wanguo Securities was on the verge of bankruptcy. And Shenyun Securities merged into Shenyun Wanguo, and later merged into the current Shenwan Hanjuan. Guan Jinsheng, the president of Wanguo at the time, was later sentenced to 17 years in prison. Liao Guofa was investigated for market manipulation and financial fraud, and the man in charge fled. 3 months later, the State Council, China's cabinet, halted the pilot program. The moratorium lasted nearly 20 years until it was revived in 2013. You see, although this is a relatively early event, it fully demonstrates the impact of high leverage in futures, and it is easy to form a forced position. A forced position means that because high leverage makes the other party lose too much through a small change in price, they can't pay the margin and are forced to close their positions. You see, at the beginning, the world was driven to a dead end because of insufficient margin. And he also used the high leverage characteristics of futures to fight back. For a time, he was forced to hold a long position, and one thing happened: double pressure. I'll tell you, this futures actually has a more extreme kind of squeeze, because many futures normally have to be delivered when they mature. Well, you think if this long position holds enough long futures, more than all the cash in the market combined. That is, there are bound to be some short positions, and he can't deliver as promised anyway. In order to avoid default before maturity, they will try very hard to liquidate their positions. You think they will try very hard, and you push the other side too hard? This is when the bulls, it's time to make money. Hey, come on, let's talk in depth first. Have you ever wondered why the number of futures contracts exceeds the number of spot contracts? There aren't that many futures contracts. Who ordered them? Let's understand a futures contract. How does it come into being? For example, I planted a tree. I tell you, this tree is amazing. Other trees bear fruit. My tree bear milk tea. Is the kind of tea with milk with ice with a straw. You can drink from the tree off the knot. It's the only milk tea tree in the world. It's amazing. For example, it grows 100 cups of milk tea every 6 months, and when it does, I sell it on the market. At the same time, the exchange has set up a futures contract for the milk tea that the tree can produce. For example, the codename for December expiry is MITS 5. It means milk tea expiring in December 2025. As long as someone wants to buy the milk tea futures, and someone wants to sell it, and the prices match. If there are 1 million people who want to go long and 1 million who want to go short, 1 million contracts are created. Conversely, if both buyers and sellers want to close out their positions, the price of the last contract disappears. Therefore, the number of futures contracts it is not fixed as the stock. It depends on the market supply and demand, and will not be limited by the size of the spot. Although I have 100 cups of milk tea at maturity, in theory the futures market can be infinite. It's easy to imagine that if only 100 cups of milk tea could be delivered, I could go long 10,000 cups of milk tea futures and not sell at any market price. So, as my counterparty short, either he defaults, pays a big fine. At this point I then take my long position out of profits. I formed a more pure milk tea futures force short. I give this example must be very extreme. There are only 100 cups of milk tea on the market. In fact, is also to make everyone more intuitive understanding of this forced empty. Actually, to that kind of more mature market, player is very much. Volume is very big. It is rare to appear this kind of force empty situation, but in futures markets where there may not be that many players, counting on two hands, there is the potential for a very extreme squeeze. Nickel is a metal that is widely used in all kinds of alloys, such as stainless steel, superalloys, etc. Naturally, it has a nickel futures market. And the protagonist of this story is Aoyama Holdings. It is the world's largest stainless steel company and the world's largest nickel producer. It accounts for about a quarter of the world's annual production. Aoyama is a big deal in a small market like nickel futures. It dominates both actual production and the futures market, but in 22 years, the Big Mac has gone awry. At the beginning of 2022, the war between Russia and Ukraine broke out, and Russia began to face economic sanctions from Europe and the United States, which happened to be a big nickel producer. That left Russia with no way to deliver its nickel. There is so much less available for delivery that the price of nickel will naturally go up. It's gone from less than $20,000 a ton at the beginning of the year to over $24,000 a ton. At this time, news came from the market that Aoyama Holdings had a large number of short positions, about 150,000 tons, and some people said 200,000 tons. Why did he have so many short positions? Maybe he's a trader and needs a hedge, or maybe it's just plain speculation. This we don't know, and is not our focus today. In short, he is holding a short position in bad futures that exceeds his short-term production capacity. Moreover, there is also a problem that the nickel produced by Aoyama cannot be delivered directly. Because it needs pure nickel for futures delivery. While the nickel produced by Aoyama is mainly iron nickel and high mat, and the purity is not enough, so he can hedge his short positions. But he can't take delivery of his own nickel. Look at this time, the epidemic caused a decline in nickel productivity. Russia was sanctioned. Nickel stocks are still very limited. Less than half of what there had been in previous years. But the nickel futures market was more than 1.1 meter tons, 15 times the size of the spot market. That's a lot, isn't it? This is equivalent to having only 100 cups of milk tea on the market, but someone has a short position of 1,500 cups, which had been soaring in price since March 22. On March 1, NI's price was around $24,000 a ton. At that time, the NI futures market leverage was about 10 times, although it was not as high as 327 treasury bonds. It fluctuated greatly. So, Aoyama Holdings was soon required by the exchange to post billions of dollars in margin deposits. He couldn't come up with that kind of cash. Feeling as a small tsunami so suddenly is really hit people unprepared. In fact, this time the short of the capital is not so firm. They are also afraid of like 327 incident in the world, as the last desperate counterattack crazy short, fight with them for capital. But later, watching this evil price continue to rise, shorts began to retreat. I feel the possibility of this happening. So the capital that the bulls are shorting is piling up. Didn't we just say 50,000 on March 7th? The bulls aren't done yet. Another frenzied round of sweeps began in the early hours of March 8 London time, with prices doubling from $50,000 to more than $100,000. At this rate, Aoyama faces losses of $10 billion. If he were forced to liquidate his position, the losses could double again. Seeing that he was dying, Bob was about to declare victory when a mysterious third force in the market intervened. Who was it? The exchange, the London Metal Exchange, announced an emergency shutdown at 8:15 a.m. on March 8, and for the first time ever, it announced that all futures trading after midnight that day, approximately 9,000 transactions, none of it counted. It was cancelled. Let me interject. We were just talking about this example. Do you feel that this exchange is always cheating? It's always going to be scrapped, not playing anymore? This is actually a rare occurrence. Because we are talking about more extreme cases, so you may feel how the exchange has become so old-fashioned. But at that time, the practice of the LME's emergency suspension and invalidation of trading can really be said to have saved Aoyama Group. From the exchange's point of view, this kind of shorting is to disrupt the market order, and he probably does not want Aoyama holding such a large client to fail. But these hedge funds you're trying to short, they certainly don't think so. The rules of the game are written in black and white. I just play by the rules. You're the clearinghouse. You can't take the lead in playing with the example we just had. It's true that the Chinese mainland is in the early days of futures trading, and it makes sense for the exchange to pull back. But you LME, Elmsersa, global exchanges are doing the same thing, so how? Therefore, many bulls have jumped out to sue the LME. And what's interesting is that under normal circumstances because the futures trading market is very mysterious, but this time they all jumped out and hit the LME, then you'll know who it is. But if anyone on Wall Street or in the financial world knows about these big-name hedge funds, you'd say they have a pretty good sense of smell. And they're very aggressive. At that time, after a few days of market suspension, the market also returned to rationality. Aoyama Group also reached a silent agreement with brokerages, creditors, and so on. That is to say, brokerages don't care if you want more margin. But Aoyama, cut your losses and liquidate your position. Aoyama is said to have narrowly escaped a loss of about $1 billion. Aoyama also narrowly escaped a loss at his brokerage firm, G. Morgan Chase & Co. In fact, of the 150,000 tons that Aoyama shorted, 100,000 tons were directly traded in the futures market, while the other 50,000 tons were held over the counter through trading with J.P. Morgan. At that time, Kingshan was forced to sell, and at one point faced losses of more than $10 billion. Couldn't he post a margin? J.P. Morgan was in the middle, scared to death. We talked about it all night, but we didn't know LME. But all told, J.P. Morgan lost a lot of money on the deal, about $120 million. And one of those shorts, AQR, his boss later tweeted a dig at Aoyama and J.P. Morgan. He said, "Well, it's nice to see that G. Morgan Chase and the big boys have only a few bruises, and the LME is fine. They didn't break the law at all. Ha ha ha." After this short squeeze, the UK also fined the LME clearinghouse £9.2 million, and the market slowly regained its former calm. You see, this is a very typical example of a futures short squeeze, when there isn't enough cash in the market. The shorts are cornered and have to panic buy to close out their positions. Every now and then we see a bit of that. There is also a more rare. It is not force short, but force long. The term long squeeze is awkward because it's so rare. The 2020 pandemic caused global oil demand to collapse, sending both spot and futures prices into a tailspin. At the same time, the OPEC oil producers' agreement to cut production has not been reached. Saudi Arabia and Russia are locked in a small price war, causing oil prices to fall all the way from us $60 at the beginning of the year to us $20 at one point. And the falling oil price has aroused many people's desire to hunt for bargains. Many of them come from the Far East, from Asia. The price of oil keeps falling. How low can it really go? But no matter how cheap it gets, it can never drop to zero, since oil certainly doesn't come for free. So China, South Korea, India-based, there is a large number of retail investors would like to buy bottom oil prices, then they buy bottom way is what? Most of them aren't professional investors, and they don't buy oil futures directly. After spotting the demand, financial institutions rolled out this so-called pure crude oil product. With it, retail investors don't need to participate directly. They can gain indirect, diversified exposure to oil futures. Pretty convenient, right? This way, even small investors get a chance to grab a share of the oil futures market. This is a very typical one, and one that later went wrong. That is, the crude oil treasure that the Bank of China launched at that time. This refers to crude oil treasure, which is a simple wealth management product for retail investors, and this financial institution, for example, the Bank of China, as an intermediary, in order to hedge risks, it will go to, for example, CME in the United States to actually trade the corresponding crude oil futures. They were trading oil futures on behalf of these retail clients, setting the stage for the crash that followed. What does a negative oil price mean? It's when I give you oil for free and give you extra money. Does that sound weird to you? Now, the financial market is really an eye-opener. So let's briefly analyze why they fell into negative territory, because someone is forced to sell, even if it is negative. I must liquidate my position. Why is he in a hurry to liquidate his position? Because if he does not liquidate his position, he will face physical delivery at maturity. There will really be truckloads of crude oil delivered to me. Then, why would I rather give a rebate at all costs? I also don't want such truckloads of crude oil delivered to my door. There are two main reasons. First of all, there was a serious shortage of oil storage at that time. Normal commodity delivery, you may feel that if it is delivered, it will be delivered. Shouldn't I just accept it? What's wrong with a little gold? This oil is here, but I don't want it. I'll just find a river and pour it. This really can't be done. It's illegal to dump crude oil in any country. And there are very strict geographical restrictions on this delivery. It doesn't mean that you just make a phone call and say, "My oil belongs to you in a village in South Africa." If you look at the delivery terms of WTI crude futures, it is clear that delivery will have to go through the Cushing depot or pipeline. This town in Cushing, Oklahoma, is a global oil refinery. At full capacity, it holds 90 million barrels. Well, when you think about it, it was because the demand for crude oil was too weak. Now the oil reserves have exceeded 80%, and the rest has been rented out, and the rent cost is very high. So even if they're willing to send it over, it's hard for you to accept it. That's one reason, but that alone doesn't make it a negative price. And the second reason is because of this overshot, there are so many retail investors that they would rather pour money into the market than actually collect gas. Just think about you charge. Can you charge? So they have to close the position before it matures. As intermediaries, the banks also know that retail investors will have to liquidate their positions. This practice is very common in the futures market. In English, it's called rolling back. And its Chinese name is particularly pleasant to hear, called the shift position for the next month. I move positions for the next month, you see, more poetic. But at that time, the Bank of China made a mistake. He didn't know why he didn't move his position ahead of time. As a result, there were only 2 days left before the closing date to begin to close the position. Look at these two reasons. The shortage of oil storage depots and too many retail investors buying low prices are all special phenomena that emerged after the outbreak of the epidemic. In addition, some institutions, including the Bank of China, failed to change positions in advance. This set the stage for an actual collapse in oil prices. On the morning of April 2020, 2 days before the May delivery freeze, there were 130,000 open lots, About 2/3 of these were longs, such as those held by retail investors through wealth management products. That's a lot. 2/3 of those positions will have to be sold within 2 days. What if you're a hedge fund speculator? It must have been a short sale. I held on to my short position. I didn't close it. I pushed the price down even further. At that time, many long positions in order to be able to ensure that the day closed under a single settlement price called TAS orders. I told the exchange, I have so many futures, please at today's closing price of 3 minutes to sell it. When the market price, I will sell at the price. That means you'll sell me out before the market closes? This TAS is actually quite common for relatively small orders. But the TAS orders on that day were so large that more than half of the positions in the market had to be sold before the market closed. And it is selling no matter how low the price is. So in fact, this TAS is a very important reason driving down oil prices. I won't be too careful about this mechanism. In the end, both sides evolved into a game. The main forces on both sides needed to close out their positions before the B market. But the key was to fight for the oil price in the minutes before the B market. If the price of oil is higher, then the selling price of the bull will be higher. And he will be happier to make money. Conversely, if the price of oil in market B is lower, the shorts will make more money. In fact, there is no logic on both sides. That is, purely drive before the B market contest who has more capital strength, who can push the price to a more favorable place for themselves. In fact, this kind of long empty battle has occurred many times in history, and the risk to both sides is very high. Because you don't know how deep the other side is and how many cards there are, because for both sides, the more money you throw in, that price is better for you. But at the same time, if you lose worse. The more they hit, the more likely they are to win, and the more they make up, the more they hit, until one side is completely defeated. The more they hit, until one side is completely defeated. This is also a death spiral for futures positions. It was also afraid that the market would suddenly show up and a big buyer would become long. But this time the situation is really too favorable for the shorts. On the bull side, he mostly buys on behalf of retail investors, so they don't have much incentive to throw more capital at Wall Street bears out of their own pockets. This led to a situation where the shorts held an overwhelming advantage. On the morning of April 20th, at around a.m., the market was calm, with futures trading at about $18. Nothing much seemed to be happening. By noon, the shorts began to tentatively attack the short. Found that there is no resistance in the market. They started selling straight away, and the price began to drop. The more fell short of the capital will be more. Many of the original long look bad began to turn round to close positions, and even joined the short team. Since midday, oil has dropped below $10, $5, and $0 at 2 p.m. without a break, but it has continued to fall. Even at the bulls weren't willing to take delivery. There are still no buyers in the market and the whole market is short. 4 minutes before the close, at 2:26 a.m., the oil price fell below $15, and at 2:28 it fell below $20. A minute later, it was below -30. By 2:30, it had closed below -40. The average price for the last 3 minutes was $37.63. That price is officially in the history books, and there are likely to be more classic examples in the textbooks. This time the exchange is the famous CME. He didn't do the kind of thing before that doesn't matter. Those forced to liquidate their positions include the retail investors behind crude. Very conservative estimates put losses on that day alone at more than $4 billion. For example, if you look at this screenshot, this investor bought 20,000 barrels of crude oil. The open average is 194 and the close is negative 266.12. That's over 9 million yuan, right? Bank of China then took on some of the losses of the retail investors, paying 20% of the principal of the customers for the negative positions. By some estimates, it lost more than 6 billion yuans. The ones who actually made money were, of course, the short sellers who successfully forced a squeeze. I remember a classic story about this futures delivery. In the 1980s, Salomon Brothers was a very good investment bank. They had a new trader who would help clients trade CME futures on live cattle. The result was due to operational errors. Should have been liquidated, did not liquidate, so he had to go to really give the cow in. He asked his boss what to do. The boss doesn't know, he's saying you're in trouble, deal with it yourself. So this fresh graduate goes 3,000 miles from New York and takes over 40 cows by himself. But he couldn't immediately resell them at a market, so he kept them for another week before selling them at auction the following week. So, when you look at the physical delivery of futures, in fact, it is not only the obligation of the seller, but also the obligation of the buyer. Look at the 3 stories we just told. All of them are the kind of fight to the death. Don't you feel that the futures market is so dark and dangerous? Just like a casino? Actually, it's not. I have to go back. Telling that story is because it's so wonderful and so classic. But don't want to distort everyone's understanding of the futures market. These long and short war, these cornering behavior, is only a side effect of futures. The reason why futures can be traded in such a large volume and can be used so widely is essentially that it is a huge risk trading market, or a position trading market. It trades not assets, not commodities, it's the positions and the risk behind them. In fact, the futures market is a bit like gambling. That is, for each contract, the long and short sides are completely symmetrical. If you make money, I will lose. If you lose, I will make money. The risks on both sides are completely opposite. From a single transaction, these 2 sides are indeed a zero-sum game. The entire futures market of tens of trillions and hundreds of trillions is a huge zero-sum game market. Does that mean that such a big market is a big casino? Doesn't he ever win? Of course not. The futures market is about optimizing global risk management by trading risk. If you are a player in the real economy, for example, you need to go long or short on commodities to hedge your business, and the leveraged funds, the hedge funds, they're really in it for the speculation. But if you look at the market as a whole, they're helping the market to achieve price discovery because they're more professional. They hire the most expert people to quantify how much the bond should be worth. What's the deal with oil demand in the second half of the year? How's it gonna change? What's the rainfall rate in Florida next month? If I find a future that's not priced properly, I'll rush in and make a profit. But I'll also push the price of the future to a reasonable level. I'll cite another very common phenomenon if we look at it from the perspective of the whole market. Asset management companies, insurance companies, they are all doing long treasury bond futures. Here I mainly refer to US dollar treasury bond futures. They have investment needs, they have hedging needs, they're long bond markets, but because of capital restrictions, repurchase restrictions, if he went to buy treasury bonds, the cost is much higher than long futures, so most of them would choose to go straight long treasury futures. There are now close to $1 trillion of them. Their counterparties are mainly leveraged funds shorting treasury futures. This capital is really powerful, there are no funding limits, the financing costs are low. It can fully bear this part of the risk. But they are not simply betting on the decline in government bonds, but they may also take a long position in treasury bonds to hedge interest rate risk. So these leveraged funds in fact eat the treasury bond futures and cash between the basis of the income, but they will be open to leverage particularly large. Then how do I call leveraged funds? This is actually a very mainstream model of optimizing the division of risk through futures in the market. This is also why I said that the futures market is a very transparent and highly liquid risk trading market. Of course, the freer the market, the more stringent regulations and laws you have to follow. Just like the more advanced the means of transportation, the more stringent your traffic regulations have to be. You invented the car, so of course there had to be traffic lights. That pairing is just perfect. It's like a complementary development. Once cars appeared, the corresponding traffic control tools had to follow, otherwise traffic would have been total chaos. You have sidewalks, you have traffic rules, and so do futures markets. At present, the speed of cars in the whole market is getting faster and faster. The traffic volume is also getting larger and larger. And the coordination of traffic regulations is also getting stricter and stricter. Just now we said that those who are purely profiting from killing each other, this kind of cornering behavior, in fact, they are the kind of traffic accidents that the major exchanges are trying to avoid. Okay, I'll talk to you about futures through these 2 videos with more than 20,000 words. Isn't it quite interesting? Say you've seen this, don't subscribe, then go. Is that appropriate? Right? That's it, bye.